Friends, we will start with the next problem, question number 13. Department X sells goods to Department Y at a profit of 25% on costs. Department Z at a profit of 10% on costs. Department Y sells the goods to X and Z at a profit of 15% and 20% on sales respectively. Department Z charges 20% and 25% profit on cost to the Department X and Y respectively. Department managers are entitled to 10% commission on net profits subjected to unrealized profit on departmental sales being eliminated. Then departmental profits after charging the manager's commission but before adjustment of the unrealized profits are X 36,000, Y 27,000, Z is 18,000. Stocks lying at different departments at the year end are as under. That is, transfer from X department to the Y department is 15,000, to the Z department 11,000. Transfer from department Y to the X 14,000, to the Z 12,000. Transfer from Z department to the X 6,000, to the Y 5,000. Find out the correct departmental profits after charging manager's commission. So now in this context, this problem do not have any errors. In the previous problem which we did, we have to first correct the errors, then calculate the stock reserve and then find out the manager's commission. But here it is not the case. And one more difference between the last problem and this problem, there for all the three departments you have only one manager, and on overall profits you are calculating the manager's commission. Here individual department wise you have to calculate the manager's commission. And one more important thing that you need to keep in the mind is, like here interdepartmental stock in the closing stock of other departments straight away given. So there is no need for calculating the same, because generally what is our approach in calculating the stock reserve? First we will look at the closing stock of the receiving department, then we will find out as a step 2 interdepartmental stock in the closing stock of the receiving department, then loading percentage, and in this loading percentage we should be slightly careful, because once it is stated in the problem that profit is as a percentage on cost, you have to calculate it as a percentage on sales, because what is a cost to the receiving department is the invoice price to the sender department, and ultimately you are creating the provision only against the what you call the profit and loss account of the sender department. So for sender department, what is the cost to the receiving department is the invoice price to the sender department. So wherever you get gross profit or loading percentage on cost, while calculating the stock reserve, please ensure what the profit percentage you are applying to the interdepartmental stock is that of the gross profit percentage on transfer price or on sales. This is one important thing that you should keep in the mind. Now once you are through with that, for us to go ahead for calculating is not a problem. But here a small error is there, not transactional error, procedural error is there. What is the procedural error? If you read the problem, down the line you have somewhere that is departmental managers are entitled for 10% commission on net profits subjected to unrealized profits and departmental sales being eliminated. But what is stated, departmental profits after charging the manager's commission but before adjustment of the unrealized profits are 36,000, 27,000, 18,000. That means what? Without creating the stock reserve, you have calculated the profits. So what you need to do first? wrongly calculated manager's commission is to be added back, and then create the stock reserves, and then find out the correct profit. On such correct profits, you have to calculate the correct manager's commission. Approach, please write down. In the given problem, approach. In the given problem, profits after charging the manager's commission, profits after charging the manager's commission is given departmental wise. However, such profits are without taking into consideration provision for unrealized profit, without taking into consideration provision for unrealized profits. Thus, we need to first adopt the following procedure. We need to adopt the following procedure. First, departmental profits after charging the departmental manager's commission. Departmental profits after charging the departmental manager's commission. Add back commission. Why you are adding back the commission? Because this particular commission is the one which you calculated without giving a due consideration for the stock reserve. So that add back commission, what you get? You get is the departmental profit before commission. What you get? You call it as a departmental profit before commission. Then what you do? Less stock reserve. Less stock reserve. Then what you do? Less, that balance will give you what? First you write the balance. Balance as departmental profits after stock reserves. Departmental profits after stock reserves. And then we have less departmental manager's commission. Less departmental manager's commission, so that what you get is departmental profit after charging manager's commission. Departmental profits after charging manager's commission. Friends, to make you to understand this, I am saying like this, but other way around we will make the full working and all. Let us suppose this is the place. You have to go to this place. You have to go to this place. To go to this place, you have to come to this place first, and then you have to go to this place. But what you did? You have gone to this place. Then what you are supposed to do? Come back from here to here, then go to this place and then come to this. It's as good as that. See, what the departmental profit that you are supplied with is without considering the stock reserves, they have calculated it. They have calculated it. So what you do? Undo what they did and do what is to be done, and then arrive at the departmental manager's commission and the corrected profits. How we are doing? Just look at statement of ascertainment of correct profit. Statement of ascertainment of correct profits. First, departmental profit after charging manager's commission. That is, how much it is? 36,000 in case of department X. In case of department Y, 27,000. And in case of a department Z, you have 18,000. But friends, this represents what? Profit after charging the branch manager's commission. Profit after charging the branch manager's commission means what? This represents 90% before charging the branch manager's commission. So, commission, add back, commission charged. Commission charged. How do you calculate? In case of X department, 36,000 divided by 90 into 10. 36,000 divided by 90 into 10 makes it to what? 4,000. Similarly, 27,000 divided by 90 into 10. In case of Y department, what does it? 3,000. And in case of the Z department, 18,000 divided by 90 into 10. That works out to be how much? 2,000. That means these are the profits before creating the stock reserves and before charging the branch manager's commission. So, 40,000, 30,000, 20,000. Then friends, what you need to do is stock reserves. How do you calculate the stock reserves? How do you calculate the stock reserves? How many stock reserves? Almost 6 stock reserves. First thing is transfer from department X to the Y what the stock you have for the department Y. See here, sentence construction you be clear with. Stock lying at different departments at the year end are as under. So transferred from department X, which is there with the department Y, is what? 15,000. When X transfers the goods, at what profit percentage it will transfer to the Y and Z? That is, department X sells the goods to department Y at a profit of 25% on costs, and department Z at a profit of 10% on costs. So now the point of interest is stock reserve to be created against department X. What I will do? 15,000 is the interdepartmental stock, and what is profit percentage or loading percentage when it transferred the goods to the Y department? 25%. That 25% is what? On cost. So how to calculate on sales? 25 divided by 125. So into 25 divided by 125 makes it to what? 3,000. Similarly, X goods lying with the Z is how much? X goods lying with the Z is 11,000. And then X, while transferring the goods to the Z, at what profit percentage it is transferring? 10% on cost. So on sales price it is 10 divided by 110. So into 10 divided by 110 makes it to 1000. So total stock reserve that you need to put against the X department is how much? 4000. Now I will calculate stock reserve to be created against department Y. How do I calculate that? That is, first Y department's stock lying with the X department, how much it is? Y department stock lying with the X department is 14,000. What is that Y adds while transferring the goods to the X? 15%. That 15% is on what? On sales. So straight multiplication कर सकते हैं हम. So do it. That is 14,000 into 15% works out to be how much it is? 2,100. Then friends, Y department's stock lying with the Z department is how much? 12,000. And while transferring to the Z, it will add profit percentage of how much? 20%. That 20% is on what? On sales. So straight multiplication. 12,000 into 20% works out to be how much? 2,400. Put together is how much? 4,500. Then friends, stock reserve to be created against department Z. Z's stock with the X is how much? 6,000. While transferring to the X, how much profit Z is adding? 20% on what? Cost. So you should be careful. 6,000 into 20 by 120 makes it to how much? 1,000. Then Z's stock with Y is how much? 5,000 into 25%, 25 by 125, 1,000. Put together is how much? 2,000. So after reducing the stock reserves, what is the profit? Profit is 40,000 minus 4,000, 36,000. 30,000 minus 4,500, 25,500. And then in case of the Z department, 20,000 minus 2,000 is 18,000. And what is stated by the problem? Departmental manager's commission is what? 10% is the commission. So what is the commission? See here, try to understand. If they simply say departmental manager is entitled for 10% commission, straight you will multiply with the 10%. But if the sentence construction of the problem says that commission percentage which they gave is after charging such commission, 10% after charging such commission, if they say like that, what you have to do? You have to feel that this profit represents 110%, then what represents 10%? Like that you have to do it. But where the sentence of after charging such commission is not there, straight multiplication of the 10% is to be made with the what you call the profits. Moreover, these profits are before charging the commission. Before charging the commission. So straight 10% you multiply. So departmental manager's commission is 10%. So what is the 10%? 600. Thereby it makes to 32,400. 25,500 into 10%. That works out to be 2,550. Making it to 22,950. And 18,000 into 10%. 1800. So that makes it to 16,200. What is that 16,200? 18,000 minus 1,800, 16,200. So with that we completed the question number 13. Friends, try to understand here. The small twist in this particular problem is what? You should be slightly careful with respect to what the profits that they gave is without charging the stock reserve. They calculated the branch manager's, departmental manager's commission, and after deducting the departmental manager's commission, what the profits you got is this. So that is error. So how you are rectifying that error? You add back the departmental managers so that what you get is the profit before departmental manager's commission and before stock reserve. From there you create the stock reserve and find out the profits. From that profit you have to go for ahead with the calculation of the departmental manager's commission and arrive at the correct profits. This is what the approach in this particular problem. Then I move to the next question, 14th question. Messrs. Bright and Company had 4 departments A, B, C and D. Each department being managed by a departmental manager whose commission was 10% of the respective departmental profits. And then subjected to a minimum of 6,000 in each case. Subjected to a minimum of 6,000 in each case. This is a very, very beautiful problem. As a continuation of this problem, when we are doing it, this really makes a sense. In what way? Here there is no minimum clause concept here, whereas in this problem which we are doing, we have a minimum clause concept. What is that minimum clause? That is in case if any manager gets a commission below 6,000 rupees, he will be definitely getting how much? 6,000 rupees of the minimum commission. And then interdepartmental transfers took place at a loaded price as follows. From department A to department B, when the goods are getting transferred, it is 10% above the costs. From department A to department D, when the goods are getting transferred, it is 20% above the cost. Department C to department D, 20% above the cost. From department C to department B, 20% above the cost. For the year ended on 31st March 1991, the firm had already prepared and closed the departmental trading and profit and loss account. Subsequently, it was discovered that closing stock of the departments had included interdepartmentally transferred goods at a loaded price instead of a cost price. From the following information, prepare a statement recomputing the departmental profit or the loss. Just go through your materials also, read carefully and understand the point there. Final profit at the loss 38,000 in case of department A. Department B, the profit is 50,400. Department C, the profit is 72,000. Department D, 1,08,000 profits. Interdepartmental transfers included at the loaded price in the departmental stock. Total is 70,000. Out of that 70,000, 22,000 represents the stock received from department A and 48,000 represents the stock received from the department C. Whereas in case of the department D, that interdepartmental stocks in the closing stock is 4,800. Out of that, 3,600 is the one which it received from department C and 1,200 is the one which it received from the department A. Now try to understand who are the transferor departments. Who are the transferor departments? A and C. Who are the transferee department? B and D are the transferee department. Now stock reserve is required to be created against what? Stock reserve is required to be created against which departments profit? Sender departments. Who are the sender departments? A and C. Against A and C departmental profits, you need to calculate the stock reserves and all. Procedure continues to be the same, approach continues to be the same. Write down the approach once more. Approach. In the given problem, departmental profits are arrived at. After charging the departmental managers commission. But without creating the stock reserves. Thus, first we should add back wrongly charged departmental managers commission. And thereafter calculate the stock reserves and deduct the stock reserves from the profits and then calculate correct departmental managers commission. So this is what the procedure awaits. Note, departmental manager is entitled for a commission of 10% on profits. However, when such amount works out to be less than 6,000 rupees, then they should be paid a minimum of rupees 6,000. Thus, in case of Department A and Department B, we need to consider the commission as rupees 6,000. Friends, it goes by what logic? Department A's situation, if you look at, in case of the Department A, it is loss situation. So in a loss situation, naturally we will be paying only a commission of 6,000 rupees only, because minimum we have ensured. Then in case of the Department B also, what made me to say like that? Because 50,400, if we feel that is 90%, what constitutes 100%? 50,400 divided by 90 into 10, other way around, 5,600, which is below the 6,000. So naturally we have paid 6,000 rupees. Logic also you please write. In case of Department A, it is in loss. Thus, it is assumed that minimum commission of rupees 6,000 is paid. Minimum commission of rupees 6,000 is paid. And in case of department B, although it is running in profits, the commission is less than 6,000. How come you came to know? Write down 50,400 divided by 90. 50,400 divided by 90 into 10. That works out to be 5,600. So accordingly, what you have to pay? Accordingly, we assume that departmental managers commission charged is 10%, is rupees 6,000, Once this concept is clear in your mind, there is nothing in this problem. We will continue. Simultaneously, you also write down the solution. First is a statement of computation of correct profit. What you do? Profit as given. How much? A, B, C, D. That is 38,000 rupees of the loss, and B 50,400, and C 72,000, D 1,08,000. Add commission, add back departmental managers commission. How much it is? 6,000. Already I explained the logic. Here also 6,000 in case of the B. Already I explained the logic. As far as C is concerned, this 72,000 represents 90%. What represents 10%? How much it is? Loudly. 8,000. In case of the D, this 1,08,000 represents 90%. What represents 10%? Loudly you need to make how much? 12,000. This is 12,000. This is 8,000. Now friends, 38,000 loss, 6,000 rupees of adding back creates a loss of 32,000. 50,400 plus 6,000 makes it to 56,400. 72,000 plus 8,000 makes it to 80,000. And 1,08,000 plus 12,000 is 1,20,000. You should be slightly careful while making these additions also. From a negative figure you add something, negative will come down. To the positive figure you add something, you get more positive figure. Back to the point. Then less stock reserve. How do you calculate the stock reserve? Already we said stock reserve is required to be calculated only with respect to the department A and department C, because they are the sender departments. See, stock reserve to be created against department A. How do you calculate? Look at the department B, and there you see how much of the interdepartmental stock of A is there with the B. 22,000. That 22,000, when department A transferred to the B, what is the profit that it has added? 10% above the cost. So what you need to do? 10 divided by 110. 22,000 divided by 110 into 10 makes it to how much? 2,000. Similarly, A, when it transferred the goods to the C, to the which department? To the D department. In D department's closing stock of total 4,800, how much comprises of the one which it received from the A department? 1,200 into, when A transferred to the D, what is the profit percentage? 20% above the cost. 20 by 120 makes it to how much, friends? 200. Put together 2000 plus 200 is equal to how much, friends? 2200. And then against department C. Department C's stock in B is how much? C's stock in B is 48,000. 48,000, and how much is the profit percentage when B transferred to the when C transferred to the B? How much it is? 20%. Into 20 divided by 120 makes it to how much? 8,000. Then friends, the next issue is like you have to understand that in case of department D, in case of the department D, how much it is going to have interdepartmental stock? C's stock in the D, if you observe, 3,600. So that 3,600, how much profit percentage? 20%. So 20 by 120, 8,000 plus 600 makes it to 8,600. Now you please tell me what is the corrected profits. The corrected profits will be 32,000 minus 2,200. How much? This is where potential error chance is there, friends. 32,000 of the loss. If you deduct the stock reserve, will the loss will get increased or decreased? Increased.
34,000.
Okay. 34,200, and then here there is no change, 56,400. From 80,000 if you reduce 8,600, how much? 71,400, 1,20,000. Now departmental managers commission less departmental managers commission. As far as A department is concerned, since it is running in the losses, happily you can conclude that 6,000 is the commission. As far as B department is concerned, 56,400 into 10% makes it to what? 56,400 into 10% makes it to 5,640. So you have to pay how much? Necessarily 6,000. And 71,400, how much you have to pay? 10% means 7,140, which is more than the 6,000. So happily 7,140. And 1,20,000 into 10% means what? 12,000. There also you don't have any problem. So corrected profits are what? 34,200 loss minus 6,000. How much it makes to? 40,200. This time the student is confident. 40,200. 56,400 minus 6,000. 50,400. 71,400 minus 7,140. 64,260. And 1,20,000 minus 12,000. 1,08,000. Right. मजा आया नहीं आए? हाँ आना. अंडरस्टैंड करके पढ़े तो मजा आता. Right. Next concept is model 6, memorandum markup and memorandum stock. This is the last model for this particular topic of departmental accounts. We have given you, of course, quite good number of problems. Now we have to travel almost from 15th question to 18th question. How many classworks and how many homeworks? 2 classwork, 2 homework. Good. But before that, a lot you need to understand with respect to the memorandum stock and memorandum markups. Friends, in this context, first try to understand what is this memorandum stock and memorandum markup. See, departmental accounts itself, when we started, what we said, are only for the internal purpose. Of course, we have a standard on segment accounting, segmental reporting and all. But even before that, we conceived the idea of preparing the profit and loss account departmental wise. Preparing the profit and loss account departmental wise. Right. Now the concept of memorandum stock and memorandum markup comes in what way? Memorandum stock and memorandum markup comes in what way? See, I don't want to tell my departmental manager what exactly the profit that I am making. Why you don't want? Please don't ask. Because that question you should have asked at an earlier stage. What is that stage? When you studied your CPT, BCom first year, when we taught you people that goods will be sent to the consignee at an invoice price, that is the intended sale price. We don't give the information of what exact amount of the profit we make on the sales made by the consignee. At that point of time, you should have questioned it. You have crossed that stage now. Why we will conceal any information from any person? Because if that other person has got an interest in this particular profit, naturally let us not reveal the true story to the other. Other than that, there is no purpose. I personally believe in preparing the memorandum stock and the memorandum markup accounts. Because here, after listening the whole lot of concept, I feel myself successful if you don't ask a question like why we should add once, then why we should reduce immediately. Instead of putting it at an invoice price or markup price, can't we account for the same only with the cost? Please don't ask such questions. Already I explained the logic behind this. Or don't ask a question saying that this much of the procedural protocol is it there when we really go for doing the accounts on departmental basis. Definitely much more complex situations are there than this. This is only a small procedure. But in the real accounts, we do so many manipulations wherein the reversals and all we do it at a later stage. Then coming to the concept of the memorandum stock and memorandum markup, let me tell you memorandum stock, how it differs from a regular stock. Friends, try to understand, in a regular financial accounting, there is no concept called as a stock account. When I say there is no concept called as a stock account means what I mean, stock records are there which will have opening stock, purchases, issues, closing stock like that. But you don't account for purchases through stock account. You don't account for sales through the what you call your stock accounts. All that where do? You do all that through the trading account. And just what you do, make the physical stock verification, arrive at what is the physical stock, you will see the book stock, then you go for valuation of the stock, and simply you pass at the year end one journal by way of closing stock account data to trading account. And the same stock will get closed next year when you start your accounts through the trading account. But in all the three topics of department, branch, hire purchase, you will find the stock accounts. So here I can confidently say that memorandum stock account is like your trading account. Why I am saying that memorandum stock account is like your trading account? Through trading account, what you are accounting for? You are accounting through trading account, opening stock, purchases, sales, closing stock. These four things gets accounted through the trading account. Even through your memorandum stock also, the same thing that you are having, that is opening stock, purchases, sales, closing stock. Sir, then in what way my memorandum stock differs from trading account? Yes, they do differ. Where they do differ, your trading account reveals the profit, whereas your memorandum stock account will not reveal the profits. Then once sales are getting closed against the stock account, which account is going to reveal the profits? It is the memorandum markup account which is going to reveal the profits. How is it possible? How is it possible that when you account for purchases and sales through the stock account, how come memorandum markup is revealing the profit? Why not the stock account is revealing the profit? Because in the memorandum stock account, all the entries which I am making are all with their markup price only. Why your trading account is able to give you the profit? Your opening stock is at cost, your purchases is at cost, your closing stock is at cost. So only thing that is with a profit element is what? Sales. That is the reason why your trading account will reveal the profit. But my memorandum stock account, which is comparable to the trading account, why it is not able to give me the profit figure? Because my opening stock is at markup price, my sales is at markup price, my closing stock is at markup price, my goods purchased is at markup price. When everything is at markup price, that is the intended sale price, the question of profit getting revealed through memorandum stock account does not arise. Then how the markup account will give the profit? What I will do is, profit elements I will transfer to the markup account. Where are the profit elements? In the opening stock I got profit. On the goods which I acquired, I added the profit loading. That also I will shift it to the markup account. Similarly, in the closing stock I got the profit element. That also I will account through the markup account. That makes us to get the profit figure from the markup account. Then we have a concept called as marked down. First, what is markup? Then you should know what is marked down. What is markup? Adding to the cost the intended profit will make that particular total amount as the markup value, which is similar to the concept that you learned with invoice price. What is invoice price? Intended sale price is called as a invoice price. What is marked down? Yes, the reduction in the intended sale price, the reduction in the markup value is called as a marked down. Friends, try to understand. 100 rupees is the cost, 50 rupees is the profit I added. Thereby markup value is how much? 150. I telephoned to my departmental manager and said, you have to make sale of this product for 150 rupees. Immediately he will tell, sir, you are sending it and asking me to make sale at 150, but I am doubtful. I will not be able to do it at 150. I can do it only at 140. In that situation, what is the reduction? 10 rupees. This reduction of 10 rupees you term it as what? Marked down. But friends, please remember, both markup as well as marked down, you will only account through one account termed as markup account only. You don't open the marked down account. It is only through the markup account only you will account for. And marked down, I think by now you are clear. What is marked down? The reduction in the markup value is called as a marked down. Now, try to understand, just like how markup amount will be there in the opening stock, purchases and closing stock, you can also have marked down where in the opening stock and in the purchases and in the closing stock. So totally you should be through with how many transactions? You need to be through with about 15 transactions, for which conceptually you should be clear with why you are passing such journal entries. Once you clearly understand these 15 transactions and entries for these 15 transactions, then you are the master of the memorandum markup and memorandum stock accounts. What are those transactions? How do you account for the opening stock? How do you account for the markup in the opening stock, marked down in the opening stock? How do you account for the purchases? How do you account for markup in purchases? How do you account for markdown in purchases? How do you account for the closing stock? How do you account for markup in the closing stock? How do you account for marked down in the closing stock? How do you account for the sales? How do you account for the errors? That is, goods purchased for one department are being sold by the another department. And how do you account for the loss in transit? How to eliminate the profit element in the loss in transit? How to account for the cost of it? Like this, there are about 14 to 15 maximum transactions for which you should know how to pass the journal entries. Please write down. Memorandum markup and memorandum stock accounts. Memorandum markup and memorandum stock accounts. In the context of departments, management intends to A. Find out the profit. A. Find out the profit departmental wise. Point number B. Find out the stocks with the departments at the end of every financial period, and then it wants to keep the secrecy keep the secrecy about profit made by individual departments. So thus it brought the concept of memorandum stock and a memorandum markup. Okay. Then write down memorandum stock accounts. Memorandum stock account. Memorandum stock account. Through this account, we will account for A, opening stock, B, purchases, C, sales, D, closing stock. Next point. All the entries into this account will be passed at their markup values. Then next point, marked down brackets, reduction in the markup, brackets close, marked down in the opening stock, comma, purchased goods, comma, closing stock will also be accounted through this account. Then friends, next point, we will find out through this account, particular account, closing stock value at its markup price. Note, this account will not reveal the profits. As all the entries are made only at their markup value. Next, side heading, markup account. This account will reveal the profit or the loss made by individual departments. So what does it? How the entries and all are, what transactions are going to be accounted for, we need to write.